Good morning, everybody, and thank you for joining us for the first episode in a three-part estate planning webinar series that we're running over the next three Thursdays. So for those that don't know me, my name is Phil Thompson. I'm the host today. I'm Central Regional Director at Deepbridge, and I'm really delighted to be joined today by Helen Hamilton and Stuart Hamilton from Oldgate Trustees, who are a tax and trust specialist law firm. Helen was an IFA for 30 years, so she sees things from the advisor's point of view, and Stuart is a solicitor with vast experience in the corporate world. I hope that's a good introduction for you. So welcome to you both. I'm also joined by somebody who may be very familiar to you, my colleague from Scotland, Mike McWilliam, and he's going to give us a view from the coalface of what advisors and paraplanners are facing in the next 12 months to April 2027. So today's episode is going to be a recap on what changed in 2026 in BR and APR reforms, and how to formulate an action plan to help advisors triage client impact quickly and confidently. And as usual, before we start, I do need to remind everybody that as we're talking about high risk investments, so as long as we keep that in mind, then we shouldn't go too far wrong. If anybody does have any questions, there's a Q&A function at the bottom. I've had one already, and I'll endeavour to slot them in as we go today. I know we've got a lot to cover, but if we can't cover them today, we can forward them on to the relevant panel member or contact at Deepbridge Capital. So let's crack on. So I'll start with yourself, Helen. So if you look at it from an advisor's point of view, and you've been there as well, what were the most consequential tax and planning changes that actually took place effective in April 26, rather than just being signposted for the future?
I think one of the most dramatic things that has happened is the reduction of the BR relief, business relief, down to 2.5 million. You know, at the time they were really talking about 1 million, which was totally ridiculous and unrealistic. They came up with the 2.5 million. But previous to that, it was unlimited. So if you had a business that you were running, a family business, which, let's face it, family businesses employ 50% of the UK workforce, and you had a qualifying business relievable business at the time that you passed away, then 100% of that was exempt from inheritance tax. Now there's only 2.5 million exempt per person. If you've got a husband and wife in there, and obviously there's 5 million between them, but that just does not cut it with some of the higher value family businesses that have been built up over many generations. In addition, it's had a massive impact on farming families, because a lot of farming families aren't necessarily cash rich. Their money lies in the land value and the sheep and cattle and the combine harvesters and everything. So, you know, how are they supposed to just find the money out of nowhere to pay the tax? And we speak to many farmers who will say the farm's been in the family for 120 years. My grandfather, my great-grandfather, etc. And it's passed through the generations, and all of a sudden, you know, we've got this to face. So they're very, very worried about what the future looks like from a business and a BR and an APR viewpoint. So yeah, we've got some strategies and solutions that we can use along with the help of the financial advisors to put them in a far better position for the future and future-proof there.
And I think it's fair to say that, you know, particularly for farmers, that, you know, that was highlighted a lot in the media. They took professional advice, and you know, it's all changed, hasn't it? They spent thousands on fees, and it's changed again. And hopefully now advisors have got a clear path of what is going to happen and how they can plan strategies accordingly for their clients. So if I can ask Mike a question. Obviously, Mike, you deal a lot with advisors and speaking to them and changes that have been happening. One of the biggest changes is obviously around inheritance from April, and why the pensions coming into the the plan, if you like. Why is it important now for advisors to start talking about it?
It's just, I think I've never had so many inquiries around this whole structural position with pensions. It wouldn't. It's just would never ever enter where we are looking at the type of tax efficient investment that we at Deep Bridge offer, EIS, BR, SEIS. It was always core ISA pension, GIA, and then unless there was a particular tax position for a sniper shot with an EIS or liquidity to go into BR, we would never see this. But now that pensions have come into the mix, along with, as Helen was talking about, the BR, the reduction from unlimited to 1 million. And I think it was the 23rd of December when everybody's on holiday. Oh yeah, we're gonna move it up to 2.5. How's that? And we've got this completely limited aspect from unlimited to limited. And now we've also blending that in with pensions, which were effectively a succession planning tool. They're not anymore. It's all of some of the questions that we've been asked over the last or since that introduction or notion that by 2027 DC pensions are going to be fully included within the estate is what's going to happen. How do we deal with this? And questions and queries around how do we strip this out? How do we take this out sensibly? So there is a massive there's a massive requirement for having those conversations with clients between now and 27, because we're sort of a month into the new tax year, a month and a bit into the new tax year, and it's just going to rattle past so quickly. So getting on the case of clients with significant chunks of pension in play is really important over the next 12 months, well, 11 months, 6 days and 4 hours.
Thank you. Yeah, I think the key thing there is it is an education, isn't it? It's something that a lot of advisors they do a little bit of BR. It was a niche product, but maybe now it's becoming more mainstream. So the landscape has changed, but certainly the opportunity is stronger than ever. And one of the things that has changed is around the AIM sort of angle, if you like, with the reduction there. So if can I ask you, Stuart, or Helen, whoever wants to take this, what are the sort of practical mistakes that advisors are most at risk of making when they've done legacy AIM based IHT strategies, and now there's a different relief treatment, if you like? So build it your ISA, build it your pension and your AIM portfolio, and now it's changed. What's got to change with strategies to accommodate that?
As we were just saying, advisors need to look at the entire picture. So all of the investments, bringing in the pension, looking at the other assets. Unfortunately, 24th of October 2024, Rachel Reeves announced that from 6th of April this year, AIM holdings would only qualify for 50% business relief, so effectively potentially subject to the 20% IHT charge. If the estate becomes taxable, the 2.5 million of business relief qualifying assets that you can have free of inheritance tax does not include AIM shares. So if your estate exceeds your standard allowances, your AIM portfolio will suffer that IHT liability. Advisors that were being proactive may have done something with AIM holdings before the 6th of April to dispose of those and reinvest in more IHT efficient investments going forward. Now, we do have this position that if you encash AIM shares to reinvest in BR, effectively you are starting the 2-year clock to qualify for 100% relief on those BR investments. However, the 50% relief will still apply, until the 2-year reinvestment time period has actually been achieved. So I think it's very much a question of looking at the overall investment portfolio and checking whether that AIM portfolio is still appropriate for the client's long-term aspiration. AIM market, I saw something to say that from October 2024 to April 2025, there was an 18% reduction in the AIM market. So it has been affected very substantially. And again, you need to look at the economics. Is it an appropriate time to change that investment?
Wow, I didn't realize it was as high as 18% reduction. So that's a significant change, isn't it? So looking at Helen, you mentioned about married couples. So how important is it to have a coordinated spousal planning strategy now that unused portions of the 2.5 million can be transferred between couples? Is that a major shift, or do you think it's going to change again, or?
Shift,
Should I
jump
in? When it was first announced, that allowance wasn't going to be transferable between spouses, which it set all sorts of alarm bells ringing.
It did, but what we did at that stage was we slightly changed tactic with regard to how we drafted the wills to make sure that spouse exemption applied, etc. As it turned out, that then wasn't needed, it wasn't so essential. So at this end, when things like this happen, we just adapt what we're doing to make sure that we can absolutely get the best out of the planning for the clients in the way that we draft the wills and we do trust planning, etc. But carry on with what you were going to say.
Yeah, we take a view that you never know what is going to happen in the future. And in some respects, it is preferable on first death to utilize the BR allowances just in case there's a subsequent rule change. And if you have an appropriately drafted will, you can lock in that BR on first death in such a way that the surviving spouse can still benefit, but you've used that allowance rather than relying on it still being available when the second one dies, and assuming that they still have the BR qualifying assets at that time.
I think what sorry, Mike, go on.
Well, I was going to say that's just good planning. That's just proper planning, as opposed to, well, let's see what's going to happen in the future. It's planning around what we already have.
Correct. And nobody should be sat there saying, oh, well, I'll just wait and see. Because if somebody had predicted what position we would be in 5 years ago, we've imagined it looks like this.
Well, who's to say that they won't come back and reduce that 2.5 million allowance downwards? Look what has happened with VCTs and tax relief on that. So as time progresses,
they'll chip away. Yeah. As long as they're in power, they'll chip away. But God knows what we'll get next. So who knows? Yeah.
Political comment.
I know.
It's an interesting point about VCTs and the 20% income tax relief and the reduction there and how it's going to affect. I think figures I've seen, and maybe yourself, Mike, the VCT businesses there wasn't necessarily a rush to get loads of money into VCTs, but whether it drops off again going forward. But certainly what it does do, it sort of brings the conversation into our space, doesn't it, with BR and EIS and SEIS, and that's what everybody has said, that, you know, make advisors have that conversation and talk about something on a tax efficient basis.
Yeah, it was it certainly was by now while tax stock lasts at 30 on VCTs. So there was very much this end of last tax year. But I guess going forward, looking at VCT, still appropriate in the right circumstances for delivering tax efficient income. There isn't really anything else out there that will do that. But where we're looking at EIS as as a mitigator, and also given the fact that pension is such a difficult with the reduction in the amount that you can put into pension, and also pension being IHT-able, then EIS is almost like a regular saving alternative to pension, creating a tax efficient bucket of private equity, gives you a diversification and a hugely tax efficient lump of capital. Build that up over 5 to 10 years, and you've got a really solid investment, plus the fact that it's outside your estate for inheritance tax purposes. So we are beginning to see the use of EIS. We've been here for 10, 12 years, but it was very definitely a tax mitigator as opposed to a tax efficient saving vehicle as part of an overall portfolio. So EIS very definitely, and to a certain degree SEIS, but that is obviously, as you said at the beginning, Phil, very higher risk.
Yeah. Okay. So I want to talk a little bit about on a corporate level now, and obviously one of the things that maybe, Mike, we've seen an interest from advisors over the last 12, 18 months is obviously talking about corporate BR and targeting or advisors looking, or I think they all have those type of clients, in their range, if you like. How do they then, what trigger points are they looking for to actually engage the conversation about a corporate BR solution?
Corporate BR, it's just all it's really happened is it's become more topical. It was always thus that a trading company that builds up too much excess cash could potentially be deemed a non-trading company, and you don't get all the benefit of BR. But as we've discussed earlier, BR was unlimited. It didn't matter. But you had to make sure your company was trading. So excess cash could potentially have reduced that or made it or nullified it. Where you were able and still are able to move that excess cash into a BR strategy, not off the balance sheet, still sits there, but the cash is then trading, and you're giving the company back its trading status. Whereas Stuart and Helen have mentioned this reduction from unlimited to now 2.5, what we're seeing is a movement of, can I call it ownership or shares, around the family to ensure that we're moving that. Everybody gets a £2.5 million BR. But if you do that and you've got excess cash and it's non-BRable, then there's a potential that the movement of shares could trigger a capital gains tax charge why am I pointing myself, from father to son? So it's absolutely vital now that the question just to ask if anybody's doing a review of clients' pensions or director shareholders in a family business, and there's thousands of them out there. How much cash have you got on the balance sheet? And that will open up a whole raft of other questions. Why do you want to know? Well, you're now down to £2.5 million. What's the value of your company, etc. You mentioned it earlier, Helen, about that husband and wife getting a £5 million. But if your company's worth 10, then that excess is going to be charged at 50% when they both go. So get the shares movement, and you can, as you'll know, you can do all sorts of things with the different types of shares. So it doesn't need to give away control of the company. But it's now absolutely vital, and I think it has come to the fore now, that a review, almost an MOT of the company's bank balance is required with that one question. How much is sat there? So it's very topical, Phil, absolutely.
We're involved in this all the time. We set up like new companies. We do company share structures. We can alter the articles of association within a company, introduce alphabet shares, even introduce a hurdle share, for example, where I think the company has potential for growth. We can do really very clever things with company shares to ensure that the company is future-proofed for the benefit of the family and the people within that family. and also keeping the shares within the bloodline.
Yep.
Can't even imagine some of the things that we actually get involved in to ensure that whatever that company looks like is completely future-proof, while also maintaining the control over who owns the shares, and keeping it in the bloodline. So that's something we work with lots and lots of business owners with, which is how we are in a position to then refer, where that comes from an accountant. We do get huge amounts of work from accountants, and you think accountants know everything, but they definitely don't when it comes to things like this.
Yep.
And that then puts us in a position where we can then refer on to the IFA, because once you bring the financial advisor in, that opens a whole new world of investment opportunity, and places to invest very, very wisely for the future.
Starting off point will be looking at, as Mike said, looking at the balance sheet and checking out, is this company going to qualify for BR? Are its activities wholly or mainly trading, or are they wholly or mainly investment? If it's wholly or mainly investment, then you fall foul of Section 105(3) of the Inheritance Tax Act, and it's not deemed to be relievable assets. As Mike says, you've then got the problem of Section 112, where you've got excluded assets, particularly cash. If it hasn't been used for the purposes of the trade for 2 years, then it falls foul of the exemption and can potentially be liable to IHT. So the starting off point for any advisor is look at the balance sheet. What do you need to do to cleanse that balance sheet to make sure you do have your BR?
And it's an sorry, Mike, go on.
No, it's just going to say that again, that almost virtuous cycle of client, accountant, tax planning, and advisor. It's sort of the Holy Trinity is between them. Everything can be covered properly.
And for the right client, it's absolutely essential. I call it the triage treatment, where you've got the IFA, the accountant, and the tax and trust specialism that we can offer. And we can do all things for those clients and keep that into sort of like a package, if you like. And it means that the professionals can have a conversation in the background about the nitty-gritty of it. Because very wealthy clients that run businesses, they're not really that interested in the nitty-gritty of everything that we do. They just want to know how it works and how it's going to work for them and their family. So the triage works incredibly well, and it's very, very good work for the advisors as well.
And it's that's the ability to, as an advisor, develop really, really core professional connections as well.
Yeah, professional connections and connections with the wider family who are your clients for the future.
Yeah, next generational stuff.
Yeah, you don't want to see that business ending when the dad keels over, and then it all sort of falls apart because they've got 3 kids and only one of them works in the business, but the other 2 want the pound of flesh as well. There's lots of things that we can do protection that definitely need to be done.
The other thing,
and one of the things that I wanted to add there is that with corporate BR, and as you said, you've got family, you've got accountants, solicitors, other professionals involved. It takes time, doesn't it, to pull these things together to get the correct outcome. I mean, from your guys, from Stuart and Helen, from your point of view, how long does it take, and why is it important to get that process started early?
It doesn't really take that long for us. I would say point of contact number 1, get in touch with us, and we'll provide an outline strategy as to what can be done. We'll then speak to the client and get to the bottom of what's important to them, etc. And then, drafting, we'll start with a really robust will, which most of our wills run to 25 to 30 pages, definitely for business owners. And within that will, we'll have a flexible framework for the future to maximise any allowances that are available at the time of death and protect the family, keep everything in the bloodline. That's the starting point, I suppose, the base of the foundation of the planning.
But from the client's perspective, the sooner they start, the better.
Yeah, absolutely.
If you think about your 2.5 million allowance for BR that each of a married couple has, that's 5 million between them. Over an 8-year period, you can double that because the 2.5 million, as per the nil rate band, is resurrected after 7 years.
Yeah.
When we're dealing with 7-year tranches, if you're starting when you're 93, then you've got less opportunity to achieve.
Yeah.
And sometimes they do come to us when they're 93. And they think, oh, what you could have achieved.
In which case,
20 years ago.
BR might be the answer.
Yeah,
there might be the
absolutely.
possibility of living for 2 years rather than 7.
Do you know what? There's always an answer. There's always something we can do to improve the situation. It doesn't matter what it is. So, you know, start with the legal and the tax and the trust advice.
And I think one of the key things for BR is with clients, it's about control, isn't it? And you know, having access to capital if they need it for whatever reason, because you never know, as you said, Stuart, what's going to happen in the future. So, Mike, if I can just ask you from you know, there's lots of different options, you know, sort of trusts and gifts and so on and so on. There's lots of things that people can do, and starting with having a proper will for a start. But you know, Mike, what are the pros and cons of each particular strategy? For example, with if you're gifting or if you've got a whatever strategy you've got, there's always a counter argument against it, isn't there? So it's not for everybody, but it's finding a blend of everything for each particular client.
It was somebody had mentioned how do we do this? How do we actually crack the IHT nut? And very simply, I mean, there's an awful lot more life cover being written. It's just gone through the roof, because if you can get the cover and it's not too expensive, then okay, you're just covering the bill and you're paying for it, but it's done. Obviously, right in trust, etc. But it's sort of sorted. But the downside to that is if you've got a 93-year-old client, you ain't going to get cover at any manageable rate. So there's pros and cons. Trust work, it's absolutely right for the right person, the right type of trust to put in place. Absolutely, and also Helen Stewart, the movement of shares into trust as well, the freezers, all sorts of different things, quite complex and by nature, but it will solve a problem where just simply putting somebody's cash into trust. If it's absolute and you need the money back, then it ruins the whole drive of the planning. It is gone, so you have to basically start again. So with a number of solutions, there's always that flip side. Whereas BR in the right environment, you're not gifting the money away, and you mentioned it earlier, Phil. It's accessible depending obviously on the asset class that the trade is running. But it's such a simple, straightforward, and we didn't have a relief before, but we've now got a BR relief. So we've got to think about ISA and pension. Oh, and BR, we've got to have a look at that, and we've got £2.5 million per person. So for an awful lot of clients who, with pensions coming back into, or not back into the IHT fold, BR becomes a really, really attractive option, simple, straightforward, attractive option for a lot of clients that weren't needing this type of planning. But it's now, because all of the restrictions and reductions are required to do some significant IHT planning. And BR is a simple, straightforward way of doing it.
And I think from our experience, we've seen that BR is probably easier to talk to with clients than probably EIS. It's potentially less risky. So it's a great starting point to have that conversation with clients and advisors, isn't it?
Yeah.
We have that conversation as well, so that I mean, obviously we can't say go to XYZ company and put your money in there. We don't do that. We bring in the advisor to actually give the advice and to fit in as part of the jigsaw. There's no right answer for everyone. It's a combination of different parts of the jigsaw that fit together perfectly for what the client needs and what their family needs. And actually, looking back, some statistics which were in place before we got all of these changes was 70% of family businesses fail to transition to the next generation. That's a 50% fail rate. And by the time you get to the third generation, it's a 97% fail rate on family businesses. Now, somebody's spent their whole life possibly building up this family business just for it to be decimated because of inadequate planning. And then if you add on top of that what's happened lately with the IHT restrictions for the BR, then I don't know how many family businesses are actually ever going to be able to survive going forward if this stays the way it is. And it's only through planning and working together that we can actually make a big impact for those clients. Otherwise, heaven knows what's going to happen.
And I think that's a great point. But I think also in the last couple of years, the amount of people that I know that are quite wealthy that have actually asked me about what to do about Rachel Reeves, and I've said, well, we'll speak to your advisor, and they said, well, I don't have one, and that's half the problem, isn't it? I think there's a lot of clients out there that need to not just advisors speak to their clients and do the reviews and so on and get this on the agenda, but also for the general public, there's an appetite there to actually speak about the things that they hear about, and they need to do something about it.
Absolutely. Just yesterday, I had a conversation with an advisor where I've sent a referral on to him for a guy that has a company that fixes buses, believe it or not. He's got a great contract. He's in his 70s. He's got his son working in the business. The business is worth about 1.7 million. He wants to pass it on to his son. We're putting in place a share structure. And what we need there, in that particular scenario, is the advice of the financial advisor who's going to come in and do some planning with regard to the son and also another key employee within that business. That is a cracking referral for that advisor.
But he was also overweighted in cash in his business, which would have been an accepted asset for IHT.
So he's got a trading business, but he's got £800,000 sat in cash undrawn in his business. So let's have a look at doing something about that. What could we do? Let's get the advisor involved. And we're doing that on a weekly basis, sending out great referrals. And that client did not have an advisor. He's had an accountant for 40 years, but he hasn't got a financial advisor.
Yeah.
Working together, it's the teamwork that really makes these things come together. And we're happy to take calls and just pick up the phone, have a little chat. I was an IFA. I'm friendly to talk to. We'll help you wherever we can, and we want to work with financial advisors. Definitely the key for the future.
Good. I'm just going to go to the Q&A because I've had a question in which something that Stuart said earlier, and it was about AIM shares. So I want to clarify this because I've heard different things, but I think there is clarity now. But if you've got an AIM portfolio, and we've got some advisors that have said to us, well, we're going to move clients from that portfolio into a BR product to put it, for estate planning. If they've done 2 years in an AIM portfolio and they transfer it, and do they start again? Is that correct now?
My understanding is that you will have your 50% relief on your AIM portfolio, but your 2 years starts again to get 100% relief. And potentially, if you had done the switch before 6th of April, it may have been different. But certainly, some of the main investment houses that I've looked at, that's the advice that they're giving.
We've got opinion on that. It's not just mine, the proper opinion, and it's exactly as you've described. There's you're no worse off transferring into BR, but you've got to get to reinstate that 100% relief. You've got to do another 2 years.
Yeah.
But if you're a married couple, as long as one of you lives for the 2 years, you've got your 100% relief.
As long as your will's drafted properly. Honestly,
Come and speak to you.
We see wills for multi-millionaires, people worth 20, 30 million, and it's literally everything each other and then the kids. That'll be what your advisors are seeing day in, day out. It's hit the client, have you got a will? Oh yes, can I have a look at it? It's about 3 pages long. You look at it, everything each other, then the kids. That is totally inadequate. And
Well,
actually 1 in 4 wills are disputed now because of poor drafting, lack of expertise, and lack of advice at the time. You don't want your client to be in that position.
you left everything to your surviving spouse and they marry again. What happens to your kids? You've got one of the kids works in the business, but others don't, but you've given them all an equal share. Well, what's going to happen to
fallout.
what's going to happen to the business? So yeah, it's planning for the family.
And talking about family, one of the things that we hear a lot, and the problems that might occur, is when the representative has got to sort everything out and they're not qualified. You know, they've probably got a lot to do at a time of grief. So, you know, it is critical, isn't it, to get a will and get it sorted and start planning early rather than leaving it to the last minute, because HMRC want the money, don't they? Has it got to be paid within 6 months?
Before interest starts to accrue.
Yeah.
That's all. Yeah.
And Mike touched on pensions from next year. The landscape will be much more complicated when dealing with an estate where you have to bring in pension pots to the equation. Having someone who is appropriately qualified to deal with the estate is going to be vital, because there is going to be so much more to do. And people thinking that I can manage 10 pension pots and tell them each how much they have to pay as their contribution to the IHT charge is going to be a nightmare. So forward planning is absolutely vital.
Not only a nightmare, but actually very, very high legal fees in dealing with probates and estates. Because if you're dealing with 10 pension pots, I'm telling you what, the client will be, or the estate will be paying a huge amount for that time and advice. However, what we're saying to clients now is, let's get you in front of an advisor. Let's look at consolidation.
Yeah.
One or two are so much better than, you know, little pots all over the place.
Absolutely. And on that theme, we've had a couple of questions asking for your details, Stuart and Helen. Sorry, Mike, not yours, but so
So I'm speed dating again.
Not again.
I think Carol's going to send an email around with all of our details on. So yeah.
And
right.
mine. I might know. No.
Everybody knows you, Mike. So. Listen, I'm just conscious of time. I think that one of the things that I get from this is that BR is always going to be a cornerstone of what we do going forward, particularly for those seeking control, speed of planning and mitigation of IHT. But it doesn't give up access to capital, but it is complicated if you've never done it before. And it's easy for us to say it is simple, but it can be complicated. You probably start somewhere. It's like having an old property. You start one job and create 10, and that's where we've got to look at it. And from an advisor's point of view, I think we've got to say, well, we're here to help, aren't we, at every stage, because it is going to be more involved probably than it ever has been before. So, you know, we're here to help. And that's what, you know, we can bring a level of expertise to different scenarios. So listen, I just want to say thank you both to Helen and Stuart and Mike for your time, but particularly to advisors, power planners that are on the call today, giving up their time. And we're going to be doing this again next Thursday, where we're going to look at how to build a robust IHT plan post reform. And again, we're going to be looking at things that we've touched on today. So we will look forward to seeing you again next Thursday at 9:30. I just want to wish everybody a great week, and we'll see you again soon. So thank you for all of you for your time.